Snapchat says that the remote work lifestyle no longer works for them because they're demanding employees to start coming back into the office come February 2023. And then Bank of America said, well, don't expect much from the stock market in 2023. So let's jump right in. Today is Tuesday, November 29th. And let me first start by talking about the health of the job market, because the job market is flipping. We've been seeing companies start to demand employees come back into the office. Obviously, Tesla was a big example of this with Elon Musk, but we're seeing more and more companies saying we need more productivity from our employees and we want employees to come back into the office, because you have a lot of employers saying that employees are not being productive enough from their home. Now, obviously, this angers people because people like the ability to work from home, people like the hybrid lifestyle, people like the flexibility, and it gets a lot of people angry because they want to have that flexibility, but employers are starting to change. They're saying we need more productivity and we have more control when you are in the office. And Alphabet, Google's parent company, has talked very openly about this because some of the biggest investors in Alphabet have written letters to the CEO of Google, Alphabet, saying that you need to start getting your employees to be more productive. Either pay them less or get them to produce more, or we are going to fire you as a CEO. That's essentially what they said. So it was kind of like a threat. And Google and Alphabet have been working, and they've sent out letters saying that you're going to have to work harder, you're going to have to work longer, and you're going to have to produce more. Otherwise, you're going to have to leave the company. This is a common trend amongst especially startup, especially tech companies, because the industry is getting hit very hard because, one, advertising dollars are going away. Businesses don't have the money to keep spending money on ads and marketing. But then second, because many startup companies have been reliant on outside capital, meaning debt and investment dollars, in order to survive and grow. And that investment dollars, those outside capital dollars, are fading away because the investment firms don't have the same access to cash as before because interest rates have gone up. And so now you have a lot of tech companies that are really feeling the pinch because now they need to produce bigger profits, they need to produce bigger earnings. And one of the ways to do that is either cut costs, meaning layoffs, or get more production from each employee. And this is the first step that companies want to do because they don't want to do layoffs. They want more production from the employees. And now Snapchat is saying that they're going to require employees to be in the office 80% of the time come February 2023. Let me read you a quick excerpt from their statement, because what they said is, after working remotely for so long, we're excited to get everyone back together next year with our new 80-20 hybrid model. Essentially, you can work 4 days in the office and then you have the option to work 1 day at home. And then they went on to say that we believe that being together in person while retaining flexibility for our team members will enhance our ability to deliver on our strategic priorities on growing our community and driving revenue growth, and on and on and on. So, according to Snapchat, having the people, the team, the people in the office will allow them to make better products. It will allow them to make a bigger profit and grow their revenues, and that's what they're hoping for. So there is a big change happening in the job market where over the last couple of years, you saw a big movement towards work from home. Then it kind of became a hybrid, and now you're kind of seeing a shift where it's still hybrid, but more and more companies are requiring more days in the office. And I made a video recently talking about this. I made a lot of people upset, but this is what the data says. I'm not telling you my opinion. I'm telling you what the data and the reports say. There's been many reports and surveys done by CEOs where they talk about if you were to do layoffs in 2023, who would be the first people that you let go? And anonymously, many people have agreed, many CEOs, that the first people that they would let go are the remote workers and the quiet quitters. So something that you need to be aware of, that if you are working a job, if you're worried about the health of the company, you might want to consider going back into the office a little bit more. That way you can show your face, that way you can keep people on your good side. Just understanding the state of the job market, because before, in 2021 especially, it was in the hands of the employee. Employees carried all the power because employers, the bosses, the companies were fighting each other to get their hands on an employee. Now it's starting to switch, where companies are doing hiring freezes, companies are doing layoffs, and employees are now having to fight against each other for a job. That means that you might have to sacrifice some of the benefits, some of the things that you like, some of the perks in order to maintain that job. But just understanding this is the shifting economy, this is the shifting job market, and we're going to see the shift continue into 2023 and even into 2024. So just understanding what's happening, that way you don't regret the decisions that you have right now. And you can be righteous or you can be right, and this is where I want you to be right. So just something for you to be aware of regarding the job market, which brings me to the topic of Bank of America and their new predictions today about the stock market. Now, we do cover this in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, I highly recommend you do so because for one, it's brief. And for two, it's completely free. And it's an easy way for you to stay up to date on what's happening in the financial markets, from the stock market to real estate to crypto to the global economy to inflation. It's a lot of fun to read, and I promise you, you're going to look forward to reading Market Briefs every morning. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. So Bank of America has flip-flopped a lot on their opinions about the coming recession or the coming economic boom or the stock market crash or the stock market boom. They kind of go flip-flop a lot more than a lot of the other banks. But today they put out an interesting statement essentially saying that this is a not so good time to own stocks because of the short-term non-growth that they predict in the stock market. Essentially what they said is the best time to be an equity investor, aka stock market investor, is when the pricing power is accelerating faster than wages and faster than people are buying. So what does that mean? It's a better time to be an investor when there's more money flowing into the markets, the prices of things are growing, and the costs of things are not growing as fast as the price of things. Now naturally, because that would mean you have bigger profits. But then they went on to say that today might be the worst environment for equity investors because wages are sticky and high, prices are falling, and demand is starting to wane. So why are they saying it's not a good time to be a stock market investor? Well, because you have the slowing economy, you have people that are not buying things, and then you have not much ability to raise prices. So that's why they're saying it's not the best time to be a stock market investor in the short term. But I think when they say investor, they're just talking about the next couple of years. They're not talking about the next 10 years because then they went on to say that over the next 10 years, they're still very bullish about the markets, aka they still think that the markets are going to rally a lot over the next 10 years. They're predicting about an 8% average gain in the S&P 500 per year over the next decade. So I guess you have to kind of define what the word investor is. What does all this mean? Well, Bank of America is essentially saying that we have some headwinds ahead in the economy. How bad is it going to be? Well, they don't know. They keep flip-flopping with how bad they think it's going to be. Right now, they're kind of saying that it's not going to be that bad. But this is where, just understanding what they're saying, that way you can make better decisions with your money and not be an emotional investor. Because if we do see pain ahead, like what many people are predicting, because the economy is slowing, because we have the interest rates rising, well, that creates opportunity for you. Because when nobody's buying, that's when you want to be considering buying. Because when everyone's running away, that creates opportunities for you to come in, find the assets, buy them at a discounted price. Because it's all about doing what the majority of people are not doing. Because if you just keep doing what everybody else does, well, you're going to end up like everybody else. And in the kind of present, that's broke. And you don't want to do that, which is where, kind of like what Warren Buffett says. Be fearful when others are greedy, be greedy when others are fearful, right? That's the popular saying. Well, just understanding that sometimes you got to go against what's conventional and what's common and what everybody else is doing. That way you can find the opportunity for you. This is Tuesday, November 29th, and as always, keep hustling.